All right, well, that was some good real estate too, right? We talk about real estate on this show a lot, and sometimes it's residential, but this time it's going to be commercial. So let's get to it, right? The commercial real estate's really not been doing very well. Commercial real estate crisis has been worsening. The U.S. commercial mortgage-backed securities delinquency rate hit 11.7% recently, which is an all-time high. That's not good. And that's now higher than the peak of the 2008 recession of 10.7. And it's only getting worse. It's safe to say that commercial real estate is here, and it's unfolding. This crisis is unfolding at a pretty fast pace. So the mainstream media only picks up on the residential real estate. It's not really letting us know about what's been happening over there commercially. But there is a rather ugly side to these bright spots in our economy, and that is commercial real estate. It's one of them. We've heard about the great earnings. We've heard about great GDP, but you know what? Commercial real estate's really starting to suffer. So we thought we'd get our next guest opinion on this matter. Please welcome to the show, Rebecca Walser. Rebecca, thanks for coming on and waiting through that. We had a little bit of a technical issue there. Thanks for being there for us. All right, well, commercial real estate not doing very well, is it?
This is such a big topic, Scott. I want to cover so many things, but I want to start off by giving the folks a common sense explanation. And that's what's really happened. Like, you know, when you graduate from college and you start making your first job, maybe you're making, I don't know, let's say 55,000 to 75,000 range if you just got a college degree. And, you know, you get what we call a graduated repayment loan program from the federal government, right? They say, oh, you're not making a lot right now. We'll do this as a 10-year repayment that'll be back end loaded. So like interest only for the first 5 years or while you're establishing your career. And this is basically, the reason I'm bringing this up, Scott, is this is basically what happened in 2008 and 2009 with too big to fail. We decided that a bank was too big, that we were going to relieve it with the TARP program, the Troubled Asset Relief Program, and buy distressed assets from the bank. Why were these assets distressed? Well, they couldn't be serviced. Servicing the actual interest on the debt was a problem for whatever. And now we're back into a situation, Scott. This is why I said last week, I believe I said, we haven't learned any lessons. We have more derivatives now than we ever had in 2008, 2009 on too big to fail. So if we didn't learn our lessons, Scott, back then, what happened was in 2008, 2009, we made a monetary theory shift. We moved to modern monetary theory. The Federal Reserve did, and they stimulated the heck out of us in two different ways over the next 13 years. Not only did we have low interest rates at a 25 Fed funds rate for almost 13 years, but we had quantitative easing 1, 2, 3, and then we have quantitative easing that's being done off the books. Different ways of doing that with the fair, open market credit operations that they run. So here's what's happened. Think about this. When you go to buy a house, if you're going to get a 2% or less than 3% rate, you can buy an $800,000 house. And the seller has 500 buyers out of the $800,000 range, so they're happy, right? When rates come into a normalized 5 to 7% range, that $800,000, now I can only afford, $575,000. So I can't buy as much. So what happens when interest rates come down, real estate valuations escalate because people are only looking, including corporations, Scott, they're just looking at the monthly nugget. Can we service this lease or this mortgage? And if they have the cash flow to service it, that's what they care about. They're not, as the consumer of the real estate, they're not looking at the overall underlying valuation. But that's exactly what the banks have to look at. When you go to refinance, you have to have that valuation continuing to go up or to be consistently there. As rates come up, you can't service as much on a higher rate. So now the valuations of real estate start to come down. And that's why all of these regional banks have not wanted to refinance their commercial real estate books, because there are a bunch of unrealized losses that will have to be realized as they move forward to refinance these loans. It's a really big problem, and we did not learn any lessons.
Right. It just kind of sounds like that issue, the unintended consequences when the government gets involved, and that's what happened around, I think, 08, 09. So now going forward, how are we going to get out of this, Rebecca? I mean, I sit around and complain a lot myself, but where's the off-ramp? How do we get out of this?
Well, there's no way to unescalate asset bubbles or to have asset bubbles. The only way to get out of this without an absolute asset kind of collapse is to have AI come in and somehow make valuations of everything, including downtown commercial office space, which is not going to happen with AI. I mean, AI is actually going to move jobs in the opposite direction. We're going to have less people needed than more people. So unfortunately, I don't see this getting fixed, Scott. We're not going to ever realize the real estate valuations that we already financed. That's not realizable at this point, because now we're going in the opposite direction, where we're going to be decentralized. We're going to be able to work remotely. We're not going to be able to work at all when AI really takes over. So from all those perspectives, real estate is going to come down, and there are going to be some asset bubbles that get punctured. Unfortunately, there's just no way we can make the real estate valuations return to what they were when people were going to the office 5 days a week before 2020.
All right. It's all about that asset price, I think, and that's really been reflected. I think you've said a great deal there. I got it all. Hopefully everybody else did too. I really appreciate you coming on, Rebecca. Rebecca Walser, coming to us from Tampa, Florida. Rebecca's Walser Wealth Management Group there too. Thanks for coming on.